Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. For this series of Father-Son Finance, it's going to look a little bit different. We've got 4 or 5 episodes out now that have been a little more educational focused. One topic, break it down, make it easy to understand, and kind of give some of our thoughts.
Yes.
So that's what we've done up until now. We'll continue doing that for different topics. But this series is going to be a little bit different. I think we're going to call it Ticker Talk.
Ticker Talk.
Or at least that's what you and I are calling it.
Right.
So we'll
Talk.
Yes.
Not talk.
Not TikTok.
Not TikTok. Ticker Talk.
But so this is going to be a conversational kind of bit on markets, current market trends, different types of investing, kind of what we're seeing, and just topics as they arise.
Okay.
So that's kind of what we're doing right now, and we are going to start off by talking about, we just are at the beginning of April, so we just ended the first quarter of 2024, and it's the hottest market in the start of a year since 2019. So let's talk through a little bit about how you might invest into a rising market.
Okay, and not only is it the strongest quarter,
Yeah.
first quarter since the first quarter of 2019, but was looking at some notes from our colleagues, Ross Mayfield, that this is the S&P 500 rose over 10% in 2 straight quarters. So we ended the year on a bit of a heater, up 10 plus percent, and we started the next year.
Yeah.
That has not happened since this is the 8th time that's happened since 1940. So 80 years of market span.
Yeah.
And this is the 8th time. In other words, about every 10 years you get something
Right.
that hot. So so how do you invest when the market just goes straight higher?
Yeah.
And to me, the smartest thing you can do is be disciplined.
Yeah.
And you do that in a couple of ways. Like, a lot of people are not excited about putting all their money to work in what they perceive to be the market high, or a higher market than maybe was earlier in the year. And I get that. I mean, that makes complete sense. But there's a couple of things you can do that we've advised clients to do in terms of dollar cost averaging. So whatever your amount is, so it's always 100%, right? Whatever, it doesn't matter what the dollar value is.
Right.
It's always 100%. Break that up into reasonable chunks. So maybe it's 25% each month for 4 months and you're fully invested.
Yeah.
Maybe it's 33% over 3 months or 6 months, whatever makes you comfortable. The key is to get in. There's a couple of old adages, Wall Street adages that are, this year's high is next year's low.
Yeah.
Right? And then the other one is the best time to invest money is when you have it.
Yeah. Yeah. So, and then one that I've heard you say a lot as well is bull markets never let you in, and bear markets never let you out. And that just goes to the point of, well, I don't want to buy at the high. Well, oftentimes all-time highs come in multiples.
Right.
Because people are excited. People are buying. There is a lot more buyers than sellers. By definition, that is what makes the market go up.
So virtuous cycles, right? Momentum creates more momentum, and then creates FOMO, right? Creates the fear of missing out. Like, I didn't get in early, but I don't want to be the last one in either.
Sure.
So I'm gonna keep going. But honestly, that saying, bull markets never let you in, meaning it never lets you buy the dip.
Right.
And then we should really be thankful that bear markets don't let you out that, because once they start going down and you've resolved yourself that you've already committed this capital, that you'll hold through the cycle, because bear markets tend not to last nearly as long as the up cycle. So that's been my experience.
Yeah. And so just to recap all that a little bit is to dollar cost average in, and you do that by, for example, you have $100,000 and you invest the same amount each month until you have that $100,000 invested by your time horizon that you've set. So maybe December 31st, and that way you're not putting $100,000 in at the market high, but you are fully invested by the end of the year or whatever your time horizon is.
Right.
And it makes it easier to get in.
And our Baird colleague, Michael Antonelli, does a great job of helping investors frame time horizons too. So to your point, if you're an individual investor, hopefully you are investing for the next decade, 2 decades, 3 decades, 4 decades. You have a different time horizon than, say, a day trader. Or say his example he uses is a sovereign wealth fund, which is looking for the next 100 years.
Forever. As long as they're around.
So, but your time frame does matter. And so if you're going to take 3-4 months to get invested, that's fine, because over the next 40 years, you won't even know that you did that.
And it's I want to point out too, people do this already with their 401k plans.
Great point. Exactly.
And so when you frame it like that to a client, it's like, oh, that's what that is. Okay, well, sure. And then they understand a little bit of how, okay, well, I put in to my 401k all the way through 2021, and my portfolio did nothing but go up.
Right. And
then I put in every month in 2022, and my portfolio did nothing but go down. But they still bought in every month, meaning that they got a lower entry point each month along the way, and they're buying more shares. And then a 2023 happens, and you own more shares now. So when you get the upswing, it compounds on itself.
And interestingly enough, in that 2021 scenario, you're actually buying fewer shares. So in a way, it's protecting you on that side too, because again, your time frame is now decades from when you're going to use that money. So those are great. That's a great point, Lou.
On that kind of same topic a little bit, but pivoting in terms of, okay, we've just come off of a really hot year followed by a really hot quarter, and now people are talking about the Fed. What's the Fed going to do? We've just seen the Fed raise rates like crazy, and now you're getting paid for your cash. So but you're paying way more for a house. Somebody like me, I can't buy a house.
You'll get there.
But you get 5.25% on your cash. So there's a trade-off there, and inflation has come down. And so the Fed has kind of done their job to that effect. And now we're in an interesting kind of what's going to happen. Are they going to cut rates? What's your feeling on the Fed there and rate cuts this year?
So I am not an economist. I am not a member of the Federal Reserve. I do not loan money for a living. So all the things that the Fed does, I don't do. The reason I think you're asking me that question is because 31 years I've seen multiple different rate cycles. So my second year in the business, the Fed raised rates 8 times in 1994. And we saw a 30-year U.S. Treasury at 8% was the coupon back then. So risk-free for 30 years at an 8%. That looks amazing today. We couldn't get anybody to invest in that back in 1994, which, by the way, that bond would be coming due in October. And so I'm just basing this off of years of watching the Fed move the Fed funds rate, because that's what they move. They don't really move the Treasury rates. They just move their benchmark, and then everything adjusts off of that.
Yeah.
And so they had to raise rates in 2022. Many people would argue, including myself, if you asked me this question in 2021, that they were late to that game. They thought inflation was going to be transitory. It was not. It was far stickier than they thought. And
depends on your time horizon.
But here we are today, and for the first time, literally since 2007, those savers are able to make money on their deposits, which I think is great. I think we've talked about it in prior podcasts. Investors should be investors and savers should be savers, and the two can intermingle from time to time. But if you're not used to being an investor, then it'll drive you crazy. All that to say that the Fed should do nothing.
Yeah.
The Fed, the economy is growing. We had an employment report that came out today. 300,000 new jobs were created last month in March of 2024. That's amazing. So, and think about that. After all of these rate increases, after inflation has come down, it's not at their target, but it is coming down.
Right.
And so we have more people working, more people earning a paycheck, and they have to spend it on things. Food, shelter, clothing, and then they like to do things. You like to do things.
I like to do things. And then you have kind of an anecdotal recession meter. Yeah. And your anecdotal recession meter is how full is the parking garage at the Lexington, Kentucky airport, the Bluegrass Airport, and I haven't seen it empty, and most of the time you have to go to the second floor.
So for 2 years, if you take a flight out of Bluegrass, this is total anecdotal, not scientific. No Fed Reserve chairman would ever consider this, but for me, the fact that the Bluegrass Airport's first floor covered parking garage has not had an available spot for over 2 years marks to me there is no recession.
Not yet.
Once we have more than one space available on more than one trip to the airport, I will be concerned about a slowing economy.
Yeah.
That's funny. Thank you.
Well, and to your point of what you talked about just a little bit ago, to go back to Antonelli as well, he brought up that point of there's more people working at higher wages that own homes at lower rates, and if those four things are true, then the economy has to do well. Now, that's not to say that things can't change.
That doesn't mean the market will do well.
Right. And so that's kind of where I was going with that, in terms of the Fed does not have a mandate to make sure that the stock market goes up.
No.
They are focused on inflation and employment.
That's it.
The stock market is a byproduct of some of the things that they do with the rates that they change, but it is not their job to make sure that the stock market goes up.
That is correct. I will say they do like the stock market to be higher, because it creates this wealth effect where we all feel like our 401k statements are higher. The value of our house is higher. That makes us feel good. That makes us get out there and be willing to spend money as opposed to pay down on debt or to squirrel it away and not spend it. So they're aware of it, but you're right. That is not at all in their mandate. And so with the economy doing well, with the market has done well, at least over the last 6 months, they are in no rush to cut rates. They're talking about it a little bit, but less so. than they were.
From January until now at the start of April.
Right.
The amount of rate cuts has already been cut in half by the street.
Right.
So who knows what will actually happen.
But it is a good thing, no matter what. It is a good thing for savers to be paid on their deposits. That keeps things in equilibrium, and we are back to a pre-2007 cycle on interest rates for savers. And even if the Fed cut by 1%, let's just say they cut by 1%. So now your money market is going to pay 4.25% instead of 5.25%.
Right.
That's still good if you're a saver by historical standard. And I mean 100-year standard.
Yep, absolutely.
So.
And on the wealth effect that you were talking about, one of the biggest drivers, or should I say 7 of the biggest drivers of that wealth effect over the last 2023, the last year for sure, and then technology as a whole for the last decade. I just think that we should definitely touch on the Magnificent Seven stocks and talk about them a little bit, because from the end of the year until now, we've seen a little bit of a shift in the Magnificent Seven. So talk about that a little bit.
Yeah, again, as the disclosures say, we are not here to talk, give advice on individual issues. We, don't buy or sell on anything that we're talking about here.
Yeah.
We're just talking. It's ticker talk.
Ticker talk.
Ticker talks. And so the Magnificent Seven is something that was coined last year, and believe me, all of the CNBC, Fox News, Bloomberg, all the financial infotainment channels, they love to coin the FANG. Was the one we had prior. That goes back to 2017. Facebook, Alphabet, Netflix.
Fan Mag,
Google, and then you added in Microsoft. They had a good, and then we replaced Netflix with NVIDIA for a couple of months, and so they love these acronyms. What's the one? The Nifty 50, which predate both of us back to the 1960s.
One of my favorites I heard was Tan Mama. Did you ever hear that one? They had just reorganized the letters, so it was like Tesla, Amazon, Netflix, Meta,
Microsoft, Alphabet, and Meta.
So Tan Mama.
And what would the other anyway?
Apple.
Apple, Tan Mama. Okay, so in other words, the street loves, or the information business news loves these acronyms.
Yeah,
but one that got coined last year, the Mag 7, was the fact that the largest 7 sort of market cap weighted stocks began to turn higher early last year. That was not expected. There was a lot of talk about recession this time a year ago. There was a lot of talk about a slowdown, job losses, etc. And a funny thing happened on the way through the earnings seasons each quarter, and that was these huge companies. I mean, and that was, Tesla, Microsoft, Alphabet, Apple,
Meta,
NVIDIA, those biggest market cap weighted stocks kept rising throughout the year and defying the odds of increasing their earnings. And increasing their earnings has the net effect of rising stock prices over time. And so people began to crowd into those trades. That has obviously, what goes up must come down in some respects, but that has stopped as of 2024. But the market is still hitting new highs because we've broadened out. And so at the first quarter of this year, what was the best performing sector for the first time in several years? Energy. So energy since 2022, it was also the best performing, coming off of an incredible low. And then finance. All of a sudden, the financial stocks. J.P. Morgan.
They have a spread to work with again.
But J.P. Morgan has had a phenomenal start to the beginning of this year. And so you're seeing a broadening out of all of these. It's not just the Mag 7. There are 493 other companies that get to play in this pool as well, and a lot of those are starting to rise. Tesla, ironically, one of the worst performers of the first quarter. So
not just of the Mag 7, of the entire S&P 500.
Right. So, those things, Mag 7, Fang, Tan Mama, all Nifty 50, all of those get their start because it's fun if you're in the business press to talk about those type of things. It's also fun to report on them when they crash, just for the record.
Yes, those headlines will be in even bigger font, I think, when and if that happens. So I think moving on from the Magnificent Seven, actually, I do have one more thing that I want to talk about that drives some of that growth. That I didn't want to miss. Because so you have these companies, these 7 companies, or insert group, high-performing group here. They report earnings. They do well. People buy after the good earnings report. And then what can happen is these index funds that people invest in their 401ks or ETFs, these index funds then have to go buy the stock because now they are a bigger part of the index. And we can get super nerdy on the numbers and how that works, but it's buying that drives more buying.
Virtuous cycle.
And so kind of what we were talking about earlier as a whole market, that happened in a very concentrated 7 stock grouping. So that was another player in that in creating the Mag 7, and they got up to 30%, almost 30% of the entire S&P 500 index.
But it won't sustain forever. Like, you have to perform as a business. I mean, that is why Tesla is down. They've cut their order numbers. Their earnings are not growing the way those other 6 companies were growing, and so just by dollars flowing into an index will not save your company from going down.
They leave just as fast.
You have to execute your business plan.
And same with Apple. Not as bad as Tesla, but they're not growing, and so they have not been rewarded.
Right. So those are things that happen that are, no matter what, that inflow of dollars is not going to save you from poor execution.
Yeah. Well, what else? You got anything else you want to touch on?
No, I think just looking into the what's coming up here in the second quarter of the year, and we're going to get into some choppy waters. We're going to get into elevated headlines on the importance of earnings after sort of last year's big move in the market, and then we'll get into the election, which we are not going to touch on this time, but we certainly will touch on in a future podcast. But those headlines are out there; they're looming, they're coming, and it's important that you just keep that long-term perspective because no matter what, if you look over 100 years. In any given 10-year time period, you're going to have 3 years that are down, 7 that are up. If you play baseball, like Louis did, he would take a 700 batting average, and he would not be sitting here talking to us.
No.
He would be making more than Shohei Ohtani.
I may be talking to you, but it would be as a client, not as an
guest.
Employee. Oh, man. Well, I think that's really all we've got. I think we're going to enjoy... despite the weather, we're going to go enjoy the races this weekend.
We got Keeneland here in Lexington, Kentucky. We've got the basketball Final Four, even though we're not in it, but it's still a basketball world around
still
here.
Still should be great basketball.
Yeah.
Men's and women's.
Caitlin Clark. I mean, and South Carolina. SEC school, undefeated. So it's very exciting.
Yeah. Got some good basketball, got some good horses. So we'll see if we can have a fun weekend out of it.
Awesome. Thanks, Lou.
Sweet. See y'all next time. During this podcast, the following individual stocks were mentioned and discussed: Alphabet, symbol GOOGL, Netflix, symbol NFLX, Google, symbol GOOG, Microsoft, symbol MSFT, NVIDIA, symbol NVDA, Tesla, symbol TSLA, Amazon, symbol AMZN, Meta, symbol META, Apple, symbol AAPL, and JP Morgan Chase, symbol JPM. Please note that Robert W. Baird Incorporated and Company makes a market in all these securities of these companies discussed in this podcast. In addition, Robert W. Baird Incorporated and Company and/or its affiliates have been compensated by JP Morgan Chase, symbol JPM, for non-investment banking security-related services in the past 12 months. Also note, JP Morgan Chase and Company is a client of Robert W. Baird Incorporated and Company within the last 12 months for non-investment banking security-related services.